The fourth financial statement we prepare in financial accounting is called the Statement of Cash Flows. It explains to the world what happened to our cash balance over the course of the year. Let's use this example of Sanders Inc. Here's their balance sheet. We can see that over the course of the year, cash went down by $16,600. Remember, in accounting, we write the most recent year closest to the account titles. So cash at the end of 2015, which is also the cash at the beginning of 2016, was $89,900. It went down to $73,300. Our job in the statement of cash flows is to explain why that happened. This is the general form of the statement of cash flows. We break it down by operating activities, investing activities, and financing activities. These can all be positive or negative numbers, but when we combine them all, they explain our net increase or decrease in cash for the year. We combine that with the cash at the beginning of the year, and we get the cash at the end of the period. So as you've already figured out, we know the answer down here before we even start. We also should have a little note if there are some non-cash transactions. For example, if we acquire some land or some equipment or a building, issuing notes or issuing stock, that should be mentioned down here in the note about non-cash investing and financing activities. So as I said, we break it down by operating, investing, and financing. I memorized that as OIF years ago. And the direct method for operating activities says we got this much cash from our customers, we paid this much cash to our employees and suppliers, so here's how much cash we got from our operating activities. But that's really complicated and expensive to do, so everyone uses the indirect method. You start with net income and you work backwards. Since our income statement was composed using the accrual method, we convert it to a cash method. And how do we define operating, investing, and financing? Operating activities are related to the income statement. It's the cash that we got from operating our business. Investing activities are things like buying new equipment, buying a new building, buying land. Cash from selling that land, selling an old building, selling old pieces of equipment. Cash from the sale of a long-term investment, it is investing activities. Or cash spent on a long-term investment. Financing activities are everything else. Things like borrowing money, paying back money, issuing stock, buying back stock, or paying dividends. So the book tells us there's three major steps. You may not do it that way. You may have your own system. But the first one is about converting our income statement from an accrual basis back to a cash basis. So we're going to start with net income, and the first thing we're going to do is add back depreciation expense. We subtracted depreciation expense when we calculated net income, but it's a non-cash expense. We don't write a check for depreciation expense. We write a check for rent. We write a check for salaries and wages. We don't write a check for depreciation expense. That cash got spent when we bought the equipment, when we bought the building. Next, kind of counterintuitively here, we have to subtract out gains. If we made money selling an old piece of equipment, it got included in net income, but it isn't part of operating activities. On the flip side, if we had a loss, it was included in net income, but selling our old equipment is not part of our operating activities. So we have to fix that by subtracting gains and adding back losses. The next step is to look at the comparative balance sheets. Let's look at the balance sheet at the end of last year and the end of this year and see if the changes in the current assets and current liability accounts related to operations can help us explain what happened to cash. For example, if accounts receivable increased, that means our customers owe us more cash, so we have less cash. If inventory increased, it means we've invested cash into inventory, but it hasn't hit our income statement yet because it's still hanging out on the balance sheet. Prepaid expenses, same thing. If we paid cash for future expenses, they haven't hit our income statement yet, so we have less cash than you would think looking at our net income. Same thing with supplies. On the other hand, on the other side of the balance sheet, if accounts payable increase, we have more cash. The example I always use is if I personally get to the end of the month and I don't pay all my bills, that means I have more cash. My account payable balance may have gone up, but I have more cash. I know I said that kind of fast, but it might help to draw a little diagram. So before I do a statement of cash flows, I make a little pretend balance sheet. And I say if accounts receivable, inventory, prepaid expenses, or supplies goes up, that means we have less cash. Just the opposite happens on the other side. If accounts payable goes up or accrued expenses go up, that means I have more cash. I didn't pay all my bills, so I have more cash in my pocket at the end of the month. So let's go back to our example. What happened to accounts receivable? Accounts receivable went down. So we have more cash. Customers from last year paid us. What happened to inventory? It went up. So we have less cash. We invested in inventory. What happened to prepaid expenses? They went up. Students often then look at equipment, but that's an investing activity. We're focused on operating activities in step one. Let's skip over to the other side of the balance sheet. What happened to accounts payable? They went up, so we have more cash. Then sometimes students go down and look at the mortgage notes or the long-term debt. You know what? That's not operating activities, that's financing activities. Okay, so now we have the information and the skill set to complete the operating activity section. We start with net income. Remember, use the indirect method. So we start with net income and work backwards to get to cash. We have to add back depreciation expense. We subtracted that non-cash expense to arrive at net income, so we have to add it back. Accounts receivable decreased by $8,700. That means customers from last year paid us, so we've got more cash. We invested in inventory, so we have less cash. We invested in prepaid expenses. We paid next year's rent. We paid next year's insurance. So that hasn't hit our income statement yet, but it's cash out of pocket. And since our accounts payable went up, that means we didn't pay all our bills, so we have more cash at the end of the year. The next thing is to look at investing and financing activities. Investing activities are things like capital expenditures, buying new equipment, or the cash effects of selling old equipment. And remember that the gain or loss on the sale of equipment does not necessarily reflect the cash that we receive. And this is the statement of cash flows. For example, if we had a piece of equipment with a net book value of $100 and we sold it for $120, the gain would be $20, but that's not the cash we got. The cash we got was the $120. And sometimes the problem will tell us how much we spent on capital expenditures. Sometimes it'll give us a mixed amount of information. So we'll have to look at what happened to the equipment account or the building account and look at what happened in the accumulated depreciation account. And if we sold some equipment, we'll have to recognize that when we sold that equipment, we took off some accumulated depreciation. And then for financing activities, we're going to look at things like the issuance of new stock, the issuance of new debt, the payment of dividends, things like that. So let's go back to our example. Let's look at investing activities. Well, the only investing activity, it looks like equipment went up. And it tells us, sure enough, that we purchased equipment for $81,400. Fully depreciated equipment costing $22,400 was discarded and no salvage realized. So that explains how this went from $268,500 to $327,500. It isn't just $81,400, it's this plus $81,400 minus $22,400. And this number increased by the amount of depreciation expense, the $41,700, minus the $22,400 of accumulated depreciation that came off when we sold that old equipment. So now we have the skill set and the information to fill out the investment activities. We spent $81,400 on capital expenditures. What about financing activities? Well, it looks like we paid off this mortgage note payable. We paid it down with $168,000. It tells us there was no penalty, so we didn't pay anything on top of that. It tells us that we sold 7,000 shares of common stock. Sometimes it'll say the sales price, but if it doesn't, we know to take the total here of common stock and additional paid-in capital, subtract the total of common stock and additional paid-in capital at the beginning of the year, and that must be how much cash we got. And then finally, it tells us that cash dividends declared and paid were $76,800. So sometimes the problem will give you all that information. Sometimes it won't tell you net income. It'll expect you to figure out retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. But I think we've got all the information we need to fill out the financing section. We sold that stock, so we got cash in. We paid off that mortgage, that's cash out. And we paid cash dividends, so that's cash out. And the third step, which could actually be our first if we want to cheat a little bit, make sure that the change in cash showing up on our statement of cash flows matches the change in cash on our balance sheet. And sure enough, 169,600 in from operating activities, 81,400 out from investing activities, and 104,800 out for financing activities gives us a net decrease in cash of 16,600 on a financial statement. Whenever you see a phrase like this, net increase, parentheses, decrease in cash, that means if it's an increase, it'll be a positive number. If it's a decrease, it'll be in parentheses. Here it's in parentheses, so we know it's a decrease. Our cash at the beginning of the year was 89,900. It goes down by 16,600 to give us 73,300. So that's all there is to the statement of cash flows. Where students often get confused is differentiating between operating activities. That's stuff that relates to the income statement. Investing activities, that's buying new equipment, buying a new building, buying new land, or cash received for the sale of an old building, old equipment, or old land. Maybe we invest in some stocks, that's cash out. Maybe we sold some stocks, that's cash in. Financing fees are things like borrowing money, paying back that money, issuing stock, buying stock, or paying dividends. And the other mistake that students often make is when it comes to operating activities, we add back depreciation expense. We don't add back accumulated depreciation. We don't add back that change. That may not necessarily reflect the depreciation expense we booked because we may have discarded some equipment. So we may have removed some accumulated depreciation from our books. And so we can't use that change to necessarily reflect our depreciation expense. Wow, that was a lot of information. But hopefully you see that we take the cash flow from operating activities, investment activities, and financing activities, and we use them to explain the change in cash for the company as a whole. Hope that helps.